This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 105 was recorded on February 15th, 2018. I'm Erik Townsend. We've got another fantastic guest for you this week. Similar to Chris Cole, who we featured recently, One River CIO Eric Peters runs a hedge fund whose strategy is very much aligned with current events in markets. Just like Chris Cole, Eric Peters penned an article back in August titled The Case for Long Volatility, predicting that the vol complex explosion that just occurred would occur and describing how to profit from it. Registered users will find a download link to that piece, as well as some of Eric's other writings in your Research Roundup email. Eric and I will discuss what just happened, what it means, and what to expect from here. We'll discuss those points relative to the vol complex itself, equity markets generally, as well as an in-depth discussion of the factors driving interest rates and what Eric sees on the horizon. Be sure to tune in after the feature interview because we have a really fantastic Postgame segment planned for you. Patrick has prepared a slide deck linked in your Research Roundup email, which charts every single 10% plus stock market correction since 2007. In other words, since we've been in the era of central bank liquidity-driven markets. And we've overlaid those prior corrections over the current S&P chart. We'll talk through how past corrections have played out and what history teaches us about what might be ahead for the stock market in coming weeks.
And I'm Patrick Ceresna. Now, Eric, that S&P 500, looks like it had put in that bottom last week on Friday, and it's been rallying ever since. What's your take here on the markets?
Well, a lot of people were panicking on Friday saying, okay, is this the Lehman moment where the next 2008 financial crisis-sized event starts? I don't think so. If we had to draw an analogy to the 2008 crisis, I would say this is not the Lehman moment. This is maybe the Bear Stearns moment. And you remember Bear Stearns was the investment bank and had a couple of hedge funds blow up completely to zero value. Bear Stearns had to be acquired for pennies on the dollar in 2007. Now, that was spring of 2007 that happened, a good solid year before the crisis really got into full swing and several months before the peak in stock prices. So if I had to guess what sort of the 2008-2009 moment this is, I think we're seeing that there is vulnerability in the system. We're seeing warning signs that something is on the horizon, but I'll be very surprised if this is it and, next week we're 500 points lower on the S&P. I just don't see that in the cards quite this early. There's another possibility, though, if I were drawing analogies to past events. The summer, not the fall of 87, but around August of 87, there were sudden volatility events that caught everybody by surprise. And they're thinking, what the heck is going on with this stock market? Up and down so crazy. What's happening here? Well, it was kind of the tremor, if you will. It was the precursor to a couple of months later in October of 87, of course, that big October crash that was 23% in a single day. Now, that's a couple of choices. One, the Bear Stearns moment was a good year and a half before things really got ugly. The summer of 87 was only a couple of months before the big one happened. So it's impossible to time these things. No crisis will look like the one before it. And I don't think that it is clear yet whether what we've seen is even over. If you look at the history, and we'll get into this in much more detail in our postgame segment, retests of bottoms are typical in these corrections. So the S&P 500 looks like it's recovering right now. I think there's a very good possibility that there could be some more downside. It's not time to sound the all clear yet on this, but in the grand scheme of things, I'll be surprised if the crash starts tomorrow. I think more likely this is a correction that's going to play out and maybe be the precursor of worse things to come in coming months. Let's step back to the really big picture, though. If I look at my view of equity markets, really going all the way back, let's say, to the 2008 crisis, as far as I'm concerned, we have not fixed, in a true sense, fixed anything in terms of the causes of that crisis. That crisis was caused by way too much private debt. We have more private debt today than we did then, and we've also moved a lot of private debt off of the private balance sheet onto government balance sheets. So the government doesn't have the ability now, it doesn't have the capacity to bail out the private banking system the way that it did back in 2008. This central bank stimulus experiment, and I emphasize, it's an experiment. Nobody in the history of the world has ever done anything like central banks have done in the last 10 years. Has lasted definitely much longer than I first thought possible, but we still don't know how it ends. And I'm not saying that means there has to be a crisis. I'm saying nobody knows how this thing is going to end. There is no person on earth that can say, well, based on history, this is what should happen, because there is no history which is equivalent to this central bank monetary policy experiment of creating trillions of dollars of liquidity in order to, I would say, continue to keep the system on life support, to keep it functioning. Now, a lot of people would say, you're crazy to say that. Look at the stock market. It's tripled since then. Look at corporate earnings. They're just so much better. Everything is great. Well, I really don't think everything is great. I think that when you create trillions of dollars of liquidity, it has to go somewhere. And it has done a wonderful job of propping up asset markets. It's done a wonderful job of keeping the system going, and it certainly has supported corporate earnings, because if nothing else, you can increase earnings per share just through share buybacks, and there's been plenty of that thanks to central bank liquidity. So we're at a point now where the central banks, by their own admission, don't have the capacity to do another bailout that's the size of the 2008 bailout. They're not able to save the day the way they did in the spring of 2009. I don't have any proof that there is a 2008-2009 size crisis coming, but the market's pretty good at sniffing out weakness, and we don't have the ability to recover from it. A lot of the stimulus in terms of the Trump policies and the infrastructure spend, that's going to play out within the next year or so. And eventually we're going to get to a situation where there's going to be more vulnerability in the system. What concerns me the most, Patrick, is it's starting to look like inflation is at least on the horizon. Maybe it's not here yet in a big way, but the reason they were able to do that massive bailout in the spring of 2009 is because there was a deflationary backdrop. There was so much debt deflation in the system that the Fed could do things which under normal circumstances would be massively inflationary and would cause massive problems. They had a get-out-of-jail-free card. They could create all of this liquidity without causing inflation because the deflationary backdrop was so strong. If we move to an environment where there's an inflationary backdrop, that's going to tie central bankers' hands, and they're not going to be able to bail us out of the next crisis if we have one. Is there really a next crisis coming? Am I exaggerating to say that? Look, I don't know anytime anybody else does, but this is, bottom line, a first-time ever monetary experiment. It's never been done before. None of that says that this is the Lehman moment. I don't think it is the Lehman moment. I think it's much more like the Bear Stearns moment or maybe the August of '87 moment. But Patrick, I really relate to the Bear Stearns moment because of my personal experience trading that and making some bad decisions, quite frankly. Let's save that for our postgame segment after the feature interview because I really want to get to Eric Peters and what he has to say on this. Bottom line, the game has changed now. Volatility is back. It's probably not going to go away. We're not going back to single-digit trailing realized volatility. And everything that we've said in the past about taking advantage of what are the cheapest option premia in history, that's all null and void now. It's not cheap options anymore. You've got to look at different strategies. Let's come back to that in postgame, Patrick. I've gone on too long here.
Let's move on to that U.S. dollar because the moment the market correction began, there was a pop in the U.S. dollar. It kind of started to work its way higher, sort of almost as a safe haven. But I would rate that as a pretty pathetic rally that it put together. And as soon as the stock market reversed, we're right back down to the lows, well below the 89 handle at this moment. What's your take here on the dollar?
Boy, this has been a tough one for me. It was, I thought, pretty darn clear once we broke down below 91 that we were headed lower. And I really felt, if I looked at the chart, like we were headed lower. All the signs were there. But my view has been clouded in the last few weeks just because I couldn't reconcile the dollar weakening, continuing to weaken, with Treasury yields increasing and gold going down at the same time. It just didn't make sense for those three things all to be happening at the same time. And I guess now I've made a fool of myself. I think it was just last week for the first time I said, okay, I can't figure out what's going on here, but the odd man out seems to be the dollar. Maybe the dollar's bottoming, heading higher. I think I got that call wrong because it's very clear from this week's chart. The dollar bounced, and it seems to be clearly headed lower. I don't think we've quite gotten to a new low print yet for the cycle, but I wouldn't be surprised if that happens in the next day or so. You know who really nailed this one, though, Patrick, is my friend Juliet de Klerk. So I took advantage of this opportunity to call her. Juliet took profits on her short dollar trade right at the bottom. She saw this bounce coming. She advised her clients to get out of the way. And right about at the top, she ended up putting her short dollar trade back on. She got her clients back into long euro versus US dollar at 123. She got them into gold at 1325 and short dollar yen at 108.8. Needless to say, all of those are performing very well. So I asked her, Juliet, help me to reconcile how it's possible for the dollar to be going down while Treasury yields are increasing and gold is going down at the same time. And she said, well, take a look at the gold chart. It's not going down anymore. I think that reaction in the gold chart is probably a reaction to Wednesday's inflation print, which was markedly above expectations. But I really have to give Juliet the credit here. So I said, okay, since you've got it right, Juliet, what should I tell listeners about what to expect next? And she said she just recommended with conviction that her clients get back into the short dollar trade. And as I say, she's not expressing it against the dollar index. She's using long euro versus dollar, long gold versus dollar, and short dollar yen. So those trades appear to all be working. She has really nailed these calls. She thinks it's going lower. She doesn't have a target expressed in dollar index terms, but she says her target for euro US dollar is 128, dollar yen 98, and gold 1530. Pretty big move up that she sees coming in gold, even from the elevation in prices that we've seen in the last couple of days since that inflation print. She's definitely been very right in the past. Say that my previous, I can't make these three stories come together, is sort of being resolved with gold moving higher, but I still don't understand how treasuries can move indefinitely higher as the dollar is weakening, unless we're really getting to a loss of confidence situation. And if that's actually happening, then I think even Juliet's 1530 on gold is going to be a conservative number.
All right, well, let's move on to crude oil because certainly that sell-off that we saw in crude is starting to retrace. I mean, we're just slowly approaching, we're right now at 61.42, heading up towards almost 62. I think that we're definitely getting some sort of short-term bounce. Was that it for oil, or do you think that there's another leg down coming here?
Well, Patrick, it's a complex picture. Let's start with inventory. API, which is the private service that reports inventory on Tuesday afternoons, shocked the market lower with significant build on inventory expectations. That really kind of defined the low point, and it completed a price cycle. Both crude as well as the finished products hit key moving averages. In many ways, from a technical standpoint, the price cycle lower completed down there with WTI touching 58.30 or so. As we look at EIA inventory, which came out on Wednesday morning, there was, in fact, a build on crude oil inventory, but not nearly as big as API had expected. It was only 1.8 million barrels. The really big one, though, Cushing, Oklahoma, drawing down 3.6 million barrels in a single week. That is a massive drawdown for Cushing, Oklahoma, and it underscores the heavy blending stock problem that Pat Hemsworth has spoken about in our previous interviews. And it really says to me, we got a problem. It's funny, just a year or two ago, we were talking about how there could be a storage crisis where there's not enough tank capacity. Now we're running a risk of not having enough oil in storage to meet blend stock requirements. And of course, the Trump administration threatening oil-related sanctions against Venezuela is not helping that situation. So Cushing drawing down 3.6, gasoline building 3.6 million barrels, distillates drawing down 459,000. Now, overall, considering there was also a rise in production, this time only 20,000 barrels to 10.271 million barrels of domestic production per day. You know, this still was not a particularly bullish inventory report, I wouldn't say, but it was not super bearish either. And I think that we'd already reached an exhaustion point where the market had sold off as long as it wanted to, at least for now, and it needed a bounce after this very big move down that we've seen, well over 10% since the highs. It's 66 and change. So we're seeing a very vigorous bounce that started right after the EIA inventory came out. I don't think it was so much that it was a bullish inventory report. It was the absence of bearish numbers that allowed the market to breathe a sigh of relief. That shot us up. Where does that put us in perspective? Well, this price correction was well over 10%. But if you look at it in terms of the really big issue I've been talking about for months now, which is the massive, massive net long speculative position, this thing only took a tiny dent out of that huge positioning. We've still got more than 1 billion barrels, which was an all-time record just a couple of months ago, of speculative net length in crude oil. Only the weakest hands got shaken out. Probably just the people that bought new long positions in January got shaken out in this sell-off, and it still took us down $8. Now, I can make two arguments from that. I could say, okay, if only the weakest hands got shaken out, and this is nothing in terms of unwinding that massive everybody on the one side of the boat situation that has been growing and persisting for the last few months. Once the big unwind starts, it's going to be a heck of a lot more scary than just $8. It's going to be a huge, huge downside. But Patrick, there's a counter argument to that, which is, wait a minute. We just went through something pretty darn significant here. We went through a moment where the stock market was down more than 10% on an intraday basis, and a lot of people thought the next major financial crisis was starting. And in that moment, only the weakest hands got shaken out, and everybody else stayed loyal to their long conviction about their crude oil positions. Probably a lot of those were hedge funds that bought those positions in the last few months, had enough profit built in that they weren't showing a loss yet. Well, if they didn't panic then, if they didn't panic when the S&P was down at 2530, why would they panic again when, let's say, we get up to 62.50? If I look at this in terms of maybe this is going to be a retrace partially of the move down, and then we get another move further down, and we're beginning a multi-month process, which I think on a fundamental basis I can make a strong argument for why should that happen? Well, hey, if the longs didn't panic when the S&P was at 25.30, crude oil prices were at $58, why would they panic when crude oil prices are at $62.50 to $64.50, which is about the logical extent of where this retrace would play out to before another leg down would start? I'm not sure that they would, and I think the answer is going to be entirely on the fundamental data that we get. If we see, as I expect we will, that there are continuing growth in the rig count, growth in production numbers, that we're producing more oil, that we're exporting less oil as that Brent WTI spread continues to narrow. If we continue to see all of those things happen, I think eventually those fundamentals trigger in the unwind of that everybody on one side of the boat situation. And boy, that could get ugly. That could be $20, $25 to the downside in a hurry. But that's not happening yet, and it's not going to happen until we see the data driving it. If we continue to see this week's 3.6 million barrel drawdown in Cushing inventory, that's not going to cause everybody to panic. That's just going to fuel things in the other way. So I think it depends on the data, and I could see it going either way. If the fundamental data in coming weeks is bearish enough to bring on that unwind of this massively one-sided speculative long positioning, it's going to create a just huge move to the downside in prices. But I'm starting to see more and more the possibility, Patrick, that if we get more positive data, it may be that, it's unusual that it happens, but maybe all of those spec longs are actually right, and we're just headed into the mid-70s, if not $80. I think eventually we're going to get to where shale production really comes online in a big way, and it forces an unwind of this. But maybe it's not time yet. The answer is going to lie in the data.
All right, Eric. Now, you already mentioned gold earlier when you were talking about Juliet de Klerk. What's your thinking? Do you have anything different on your mind about gold?
Well, I think it was definitely the inflation print plus 349, way above 0.2% consensus that was the main driver of this big move up. What we're seeing right now is kind of a flagging pattern after hitting 1350 or so. If we see a decisive break above 1360, and particularly above the previous high, whatever that was, somewhere around 1370 or so, that tells me Juliet's got it right. We're headed probably to 1530. And when I've been puzzled as to why the heck gold was not moving to the upside in the last few weeks, maybe I should have been buying gold instead of talking about it on the radio. Beyond that, I think we've covered it.
Eric, let's move on to the 10-year Treasury yields. We are still north of 290 here. Are we heading to 3%?
You know, I won't be surprised. The question on my mind is how far can it really go? And I definitely want to get into this with Eric Peters. I don't really have an opinion in the short term. I did ask Juliet to clerk this. She's recommending a 210 steepener. She's also buying outright long fives only on dips. She got her clients into long fives quite a bit lower than where they are right now. But as far as my own view on this, I don't really have one other than I want to understand what the drivers are behind this term premium increase. Is it inflation expectations? Is it deficit spending expectations? What's driving it? How far can it really go? Because there's a lot of evidence here, Patrick, that says we're at the beginning of a really big trend that could be real important. Time to short 10-year treasuries, time to believe Bill Gross that the secular move away from the bull market in treasuries is over, and it's bear market time, and it's time to be short. The thing is, I just don't see how far this can go before it creates a major funding problem for the ability of the government to roll its debt forward. You know, this is the classic argument that we've talked to Lacey Hunt about on this program. So I need to understand more of it. Let's get into it with Eric Peters.
All right, well, thanks for the summary, Eric. Now, this week's featured interview guest is One River Asset Management CIO, Eric Peters. Eric's interview with Eric Peters is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me next on the program is Eric Peters, CIO at One River Asset Management. I want to let our listeners know that we are taping this interview on Wednesday afternoon, so our conversation will not reflect anything that happens on Thursday. Normally, we don't need to tell you that, but things are happening so quickly in the market, I wanted to make that point. Eric, I think that the question on everybody's mind as we're looking at the tape on Wednesday afternoon just before the close, looks like we're going to get back above 2,700. Is a relatively small market dislocation just ending now? Is this all over? Or is it more the case that a really big event is only just beginning and we're looking only at the appetizer in a bigger story here?
I think it depends on your time horizon. If you step back, what we're seeing is another, what I would call trail marker on the path to what seems quite obviously to me to be a changing macro environment. You know, I think the things that we look for most often that are most meaningful to markets are moves that happen seemingly out of the blue that lack really good explanations. This is exactly the type of move that you see when you're in a transition phase for markets. In other words, it's fine for people to look at this move and say a 0.3 increase in average hourly earnings precipitated a 10+% decline in the market out of the blue. But I think there's a lot of backfitting going on. I think there's no specific and good reason for this move. I think it's reflective of some major forces changing underneath the market. That's not to say that there aren't buyers of the dip. There clearly are. I think that there's still an awful lot of people in the market that are conditioned to sell volatility and to buy the dip, and I think we're seeing that happen. But this, I think, was a very important move.
In terms of what actually happened here, there seem to be several competing theories. Some people say this is entirely about the backing up of Treasury rates and the pressure that creates on equities. Other people have said that's where it started, but really it was the vol complex blowing up and the VIX ETF situation that occurred that exacerbated that equity sell-off. And then just this week, Zero Hedge has been pushing a story that actually describes the possibility of an intentional malicious attack where someone spoofing option quotes intentionally blew up the vol complex, and that's what caused all of this. How do you see it? Is it possible to tell which of those things or maybe something else caused this? And what do you see next in terms of how this resolves? Do you think we're headed back to, yet again, more all-time highs, or are we maybe looking at a failed rally in the making?
They're good questions. They're difficult to answer. I think people in our industry are often keen to explain why things happened in pretty precise ways because it gives them comfort that they're in control of their destiny, so to say. The truth is often that particularly moves like this, they have many contributing factors that lead to them, but it's difficult to assign any of the specific things that you came up with as the real drivers of moves. There's no question that in an economy and in a financial system where there's the level of debt that we have and the sensitivity to interest rates, that rising rates are kind of a precondition to equity market disruptions and sell-offs. I think that the level of volatility selling and its integration into risk models across virtually every type of investment strategy are contributors, and having gone through such a long period with very, very little movement, I'd say that many people's trading books were robust for relatively small moves, but once you passed a certain move, and I think in this case it was probably the S&P down 3-ish%, that triggered a whole series of different adjustments that people needed to make to their books and their option books that then amplified the move in volatility and led to this blow up in the VIX products. But we have to remember that these VIX products were extremely ill-designed, and they were very vulnerable to this. And they're a rare thing that you see in our industry, which is they had a predefined stop loss, and markets are pretty good at finding stop losses and triggering them. I started my career in the commodity pits, and I kind of witnessed firsthand how the commodity pit is built around finding stop losses on the top side and the bottom side of the market. So I think the market did a great job of finding the stops and in this case, finding the weakest ones, which were in the VIX complex, and hitting them. But I don't think that really explains why this move happened. I think, why did we get the first leg down, and why are markets starting to move with very little news flow? And that, again, that's kind of, I think, is something that's difficult to explain. There are a lot of people that are trying to do it. My strong opinion is that it's really meaningful simply because there is not a very good explanation. We're entering this last phase of the economic cycle, and markets are in the process of starting to move in ways that anticipate larger moves ahead.
I'm curious, when you say that these are very poorly designed products, I mean, even the XIV did what it was designed to do. Obviously, there were a lot of retail investors who didn't really understand the risks that they were taking. What do you mean when you say they were poorly designed? Do you just mean that it's a product that probably didn't make a lot of sense for a lot of people who were holding it? Or what specifically do you mean when you say they're poorly designed?
Number one, I think they were very likely inappropriate for a lot of people that bought them. They're classic late cycle type products that in many respects, they're designed to try to create returns in a world where it's difficult, to find returns. And so, late cycle, you tend to see these things pop up that provide enhanced levels of carry or some type of return that looks safe and, is a lot less so. They were likely inappropriate for people, but I assume that people had a sense for that. I think the design flaw specifically is to have a large retail product that has the ability to fall to zero in a day, provided there are a number of conditions met, but principally the front month VIX future has to go up 100% for it to lose 100% of its value, means that product by design, the bigger it gets, the more likely it is that as the VIX moves up in a rapid way, the market is able to anticipate that there's a very, very large buyer and they know exactly where the stop loss is. And the market will tend to suck itself up, or the VIX market will tend to suck itself up to that level because it knows that it has a forced buyer at that level. It's a very ill-conceived product. If you have a stop loss that's that big, it's reckless to show the market where it is, and these products were designed so that the market always knew where that stop loss was.
That's an excellent point. Let's come back to rates, which clearly were a driver, at least in starting this. The version of increasing interest rates that we want to believe is that it's an indication of a strengthening economy. Everything's getting better. The future's so bright, I got to wear shades and turn the interest rate up a little bit. Of course, that's not the only reason. A lot of people have speculated that deficit spending and President Trump's budget may have been what's behind this recent move up in rates. I'm personally having a really hard time reconciling, regardless of what's driving it. We've got really strong weakness in the U.S. dollar, and the normal macro function of better Treasury rates attract more capital. Dollar goes up as Treasury rates goes up. It's not happening here. So what do you think the driver has been behind this increase in rates? And how do you reconcile the fact that the U.S. dollar is not moving up as these rates move up?
There are a few questions in there, and they're questions that we think about a lot. The rates it's a tricky, and I say it's tricky because we can all recognize that we have extremely low nominal interest rates relative to history, and we're not far above 5,000-year lows. We still have major central banks in the world severely negative interest rates, and there's still an awful lot of bonds that are trading at negative interest rates globally. So interest rates, just generally speaking, are very low. Debt is extremely high, and inflation has remained low. And so we're somewhat caught in a dynamic where it's extremely difficult for rates to go up very high without raising a significant burden on economies. The only way to alleviate that burden is to create more inflation. But I think as everyone looks at the world as they see it today, they go, well, it's going to be difficult for inflation to go up very far. Consequently, rates can't go up very far because if they do, essentially bankrupt economies. And obviously, they won't bankrupt the whole economy. They'll pressure it enough so the economy will tip into a significant recession. People's mental model is roughly speaking that. And so they look at it and they go, well, rates are very low, but they can't really go much higher without sinking economies in a recession. Consequently, they're going to be around the same unless inflation moves up substantially. That last part that I think is what's necessary, and ironically, it's what the major economies in the world are really seeking to deliver right now. They're not looking to deliver a 1970s type inflation. We've reached that tipping point within society where income inequality has become sufficiently large that we're seeing political shifts, whether it's here in the U.S., in the U.K., and in Germany, certainly in those three places, where there's clear pushback by the mid-skill worker against low wages, low wage growth. And as these things happen, as political winds shift, we're seeing some of the natural consequences, which is, let's call it deglobalization. I don't think it's going to be a radical deglobalization, but it's pretty clear that we're seeing policies in these various countries that, on balance, are going to lead to less globalization. And those factors, combined with already very low unemployment, should lead to higher levels of inflation. I think we're starting to see that right now, and that's the thing that's going to allow interest rates to move higher. I think it's probably good for society overall, although it's certainly not going to be good for financial assets ultimately. That's how we're looking at the bond markets, the rate markets. Embedded within that, incidentally, is an awful lot of supply, both through lower levels of QE or the unwinding of balance sheets, but also just very, very large deficit spending. So it seems that there are a number of forces that are going to be pushing rates higher. That's the lens through which we see higher rates. I think your second question, which is, despite higher rates, why is the dollar performing so poorly? That's really a fascinating question. And I say that because it's exactly the type of thing that we really look for when we either seek out opportunities or we look for confirmation of our investment views or theses. One of our strongest investment views is that we're transitioning from a reflationary economy here in the U.S. toward a stagflationary economy. And stagflation brings up in people's minds visions of the 1970s. And I think it's highly unlikely that we see something that looks like the 1970s. Every period has different dynamics, and the 70s had very different demographic dynamics, amongst other things. But we do think that we're shifting toward an environment where there are significant numbers of capacity constraints in the U.S. economy. one of which is our labor force. Obviously, unemployment is very low, 4.1% right now. It's kind of the lowest levels that we've seen, or roughly speaking, since the 1960s, which incidentally is when inflation was also extremely low and then started moving materially higher. But we think that the deglobalization that we're starting to see will combine with some of these capacity constraints to shift us into a stagflationary world where growth is constrained by only modest increases in productivity combined with relatively anemic levels of labor supply. And we'll end up in a position where growth doesn't expand a whole lot faster than it is right now, but inflation starts creeping up. And in that world, what you inevitably see is you see a very equity unfriendly environment because you see, input costs going up, labor costs going up, you see margins shrinking. That's a difficult environment. But one of the things that you also see is what needs to happen in order to accommodate the difficulties that you're seeing in the economies. You need to see a weaker dollar. One of the things that I think lost in a lot of macro analysis right now is that unit labor costs in the U.S. relative to its trading partners, it has not been moving up in an explosive way, but it's been steadily trending higher. And the consequence of that is the dollar is becoming more and more expensive on a relative basis. And so we think that a stagflationary environment characterized by rising rates and declining U.S. competitiveness demands a weaker dollar. And so that's why we think the dollar has been weakening. I guess the last thing I would say is the reason we get so excited about seeing market movements that's so counterintuitive is because it tells you that most market participants are kind of on the wrong side of the trade and they have the wrong mental framework. So last year, for instance, people were excited about the dollar because they thought Trump trade was going to work, Trump was going to stimulate, Trump was going to introduce border taxes, these various things that would push up the dollar. And the dollar started weakening because people lost faith in Trump's ability to get anything done throughout the year. And that all made sense as kind of a mental construct around how markets were moving. Where it broke down was this year where Trump got the tax reform and tax cuts through, and yet the dollar continued to fall. And that was a signal to us that this stagflationary dynamic is beginning to manifest itself in such a material way that the markets are moving in spite of the fact that people don't understand it and are fighting it.
On the topic of inflation, Eric, you said that you see a lot of forces that are going to cause inflation to come back. Now, you also said that you don't see it getting to 1970s style of inflation. So I assume by that you mean you don't see it getting that high. It seems to me that, as you also said, we've got a problem here, which is rates can't go too much higher because it would bankrupt the U.S. government if they did. So it seems to me that in terms of monetary policy tools, if inflation were to start to run away, the Fed's ability to contain it by aggressively raising interest rates is kind of broken, or I would see it as broken. I think that their hands would be tied and it would be difficult for them to very aggressively raise rates. So you must see for some reason that this inflation kind of contains itself and doesn't require any monetary policy in order to prevent it from running away. Is that right? And if so, why do you see it that way?
I think that your insight is absolutely correct in that the world that I'm framing is one where monetary policy and its ability to interact with financial markets and the economy is going to look awfully different from what we've grown accustomed to. And that's going to create a really interesting market. Incidentally, I think that you're seeing clear confirmation of this in the way the Fed is speaking. So unlike 10% correction out of the blue that I've seen over many years, this time around, we haven't seen a Fed member come out and say, we're going to be really supportive of the markets. In fact, every single Fed governor who's spoken, and there have probably been 5 in the past couple weeks, and then there was Yellen a couple Fridays ago on her way out, they all said that is rather capable of dealing with the decline in equity markets and asset prices, and it should do just fine, and we're not really worried. I think that what they're in the process of doing is they're beginning to shift the way they communicate with the markets, and they're signaling that they're no longer going to be there the way that they have been. And there are a few reasons for that. I think number one is because they recognize that at 4.1% unemployment and a $1.5 trillion tax cut and a $300 billion budget boost and a $90 billion hurricane recovery spend, and then something that amplifies it with infrastructure spending, they're looking at this and they're saying, there's just literally no way this is not going to lead to higher levels of inflation. Again, I'm not saying 1970s inflation, but higher levels of inflation. In an economy that is capacity constrained, we're not really in a position to boost it by doing QE. QE is not really meant to be a recession fighter. It's meant to be a financial market implosion, insurance program where you can take different economic actors, in some cases even governments, and you can, buy their debt and make them solvent again, or at least appear solvent for a period of time so that they can heal. These are not tools that are going to be appropriate to fight the next recession. And I think you're seeing really smart guys like Ray Dalio come out and kind of signal that as well. So like the people who really understand how economies work and the monetary policy interacts with it recognize that the next cycle is going to look awfully different. The only question is, when does the next cycle come? I don't think that higher rates will bankrupt the U.S. government. I actually don't think that you can bankrupt the U.S. government simply because we have a reserve currency and we can print as much as we want. But I do think that significantly higher rates will make it very difficult for corporates and just for the economy to function well. So there's a natural limit in the absence of inflation where higher rates will really start to hurt economic activity, and that will be a reflexive process. And so it's difficult for rates to go a lot higher unless inflation starts picking up.
I want to pick up on that idea of corporates going higher. One of the views that I've had is that a whole lot of this really massive rally that we've seen in equities has been driven by corporate buybacks, and a lot of those are financed with junk bonds. So it seems to me that as rates pick up, eventually you get to a point where it's no longer economic to engage in these share buybacks. And it seems to me that potentially starts a vicious cycle where you can't do the buybacks anymore, rates are going up, and it leads to a major change in direction for equities. Am I right to think that that's a risk, and how do you see that in terms of how substantial of a risk it might be?
I think it's a risk. The process will probably be gradual, and then until it is not gradual. I guess that's not saying a whole lot, other than I don't think that we're on the cusp of buybacks all of a sudden just stopping. I do think that we're in a period, however, where we've had this massive financialization of the U.S. economy that's been driven by QE. It was one of the unintended side effects of QE and one of the great weaknesses of QE. And I think that the folks who implemented QE and have sustained it were hopeful that low rates would lead to more economic activity and ultimately that would be self-sustaining. What they discovered was an awful lot of that money went into some of the activities that you just described, like buybacks and debt issuance at low yields. What it distinctly did not go into was in capital investment, and that's one of the reasons that we have many of the capacity constraints that I described earlier. What I think is highly likely to happen, and I think we're in the beginning stages of this happening, is that corporate CFOs, they don't think in 6 months or even necessarily 1 year terms when they're thinking about these buybacks. But they're looking out at issuing debt over 5 years or 7 years or whatever it might be, and saying, well, we can issue debt at such and such a yield, and we can buy our stock back, and that makes a whole lot of sense. And that seems like a pretty good investment. I think what's beginning to happen is that as they're seeing rates rise and they're seeing the prospect for sustained rate rises in over the coming 5 years or so, they're saying, we're not going to have to roll that debt at potentially much higher levels. And the levels are already starting to go up. And oh, by the way, we haven't made a lot of CapEx investment or replaced some of our aging equipment. So why don't we start shifting that mix? And again, that's the type of mix that leads to hotter economic growth, all of which is being compounded by tax policy, compounded, if you want to look at it, by tax policy. And these are the types of things that I think will lead to higher inflation, higher rates, and that's really that's what I think is going to hit the equity market toward the latter part of this cycle. We may or may not be there right now, but I think that's the end game for this cycle. Somewhere along that path, by the way, it makes sense to me that these CFOs will engage in even fewer share buybacks, and that will remove another level of support for the market. But I don't think the market's going to fall just because they're gradually doing fewer buybacks. That's how I see it all connected.
It seems like we're getting a different tone out of the Fed, out of the Powell Fed, as opposed to the Yellen Fed. Seems like the message is pretty clear that, hey, we're on our path toward tightening, hiking rates in the front end of the curve, shrinking the balance sheet in terms of beginning to unwind what happened from QE. And by the way, if that disturbs markets, markets can take care of themselves. We're not in the business of bailing out the stock market. Now, I would contend that they are in that business. It just depends on how bad it gets. But they're saying that they're not in that business. So what do you see on the horizon in terms of how the Powell Fed will differ from the Yellen Fed? And do you think they're serious about not bailing out the stock market, or does it just have to get really bad before they start to look at more easing and more accommodation?
Easing and accommodation right now is something that they know that they simply cannot do, even if the equity market were to fall 20% from here, which is incidentally one of the reasons that I think the equity market's more fragile than people think. And the reason I say that is the following. Every central bank in the world post-QE has grown very concerned about not only financial stability, and that has to do with this financialization of the economy and buybacks and high asset prices, et cetera, but they're also really worried about what to do in the next recession. We all know that, right? But the question is, what's their reaction function to that? And the Fed is clearly trying to buy itself enough space through rate hikes and balance sheet normalization or reduction so that they have some tools in the next recession. They really don't know when that is. I think that they generally expect it to be somewhere out anywhere from 12 to 30 months from now, something like that, whether they admit that or not. I think that everyone recognizes that that's a real risk, right? So the question is, what do they do about it? I think that one of their greatest fears right now is the prospect that we go into recession at the tail end of this enormous stimulus, both through taxes, through increased budget, through infrastructure, through hurricane rebuild. Their greatest fear is that we go into the end of this cycle with a PE of something like 25 on the S&P and relatively speaking, modest rates, and all this stimulus having just hit the economy. And then we go into recession. And their fear is that at that point, we actually will have pretty material inflation, and we'll have a very limited ability by the politicians to do some type of fiscal stimulus. If that happens, they really have extremely limited tools. QE will be completely inappropriate for that. Rate cuts on the margin may be helpful, but there's a case to be made that in that type of environment, there's very little the Fed can do. And these are smart people. I know that people like to make fun of them. I certainly do at times, but they're smart people. I think that they're trying to think out over the next year to 2 years, and they see that scenario as being a very scary one. So I think some of the reasons you're seeing them signaling or sending a different tone right now in their statements about this recent volatility is I think they actually want volatility. They do not want people to be extremely short of vol, after the stimulus is through. They'd rather see a stock market correction, even a bear market, sooner rather than later, so that the starting point for asset prices is not extremely high at the point where they're most vulnerable to an economic recession and, policymakers can't do another big $1.5 trillion tax cut.
You made a really excellent point earlier about the blow-up in the vol complex, describing how everybody knew where the stress point was and what would happen if it got there, and the market basically seeks those things out. I think you just made a really excellent argument for why the Fed is going to be out of bullets and not really able to respond to solving a market crash. Does that mean that the market kind of smells that out, realizes that the Fed put is gone, and that dramatically increases the risk of exactly that outcome occurring?
The most likely market path at the end of this economic cycle, and remember, we're in one of the longest economic cycles in history. If we make it out to mid-2019 without a recession, I think that it's the longest economic cycle since the mid-1800s. And, we're talking about a long cycle, right? I think the most likely market outcome is something that does not look anything remotely similar to 2008. I think that the most likely market outcome looks a lot more like a 1987 or a 2000 dot-com type crash. It's a much steeper path. And I think that for a similar reason to that kind of that ETF example, I think the market does a very good job of finding the Achilles heel of a financial system, or in the case of the ETFs, the Achilles heel of a particular product. And that's what it's most ultimately vulnerable to. And in this case, given how intricately volatility-based risk management systems have been embedded in portfolio construction and the way people take risk, whether it's at a bank or a pension fund or an endowment or a hedge fund or even in a whole host of retail products and retail portfolios, given how volatility has become intricately embedded in these things, it has been the case, and I think it will continue to be the case, that the lower volatility is, the more risk that economic actors throughout the financial industry take. And the consequence of that is that what all of those models and those portfolio constructions are most subject to is a dramatic, swift reversal in the market. And we got a glimpse of that, just now in Feb. That is something that's going to be with us until people look at portfolio risk in a very different way. And I don't think that's going to happen anytime soon. So I think when this market turn comes and it becomes better known that the Fed is not there to catch it, I think that we'll have a very swift and very deep correction. There are other potential inputs and reasons that I could go into for that, but that probably take a lot longer. But yeah, I think that it's very clear that that's the greatest pain point for this market is a discontinuous move or very rapid move down.
If I think about when something like that might happen, a week ago when we were 10% off of the highs, a lot of people were saying, oh my gosh, this is the Lehman moment. It seems to me, if I had to draw an analogy to 2008, that market cycle, it's not the Lehman moment. Maybe it's more like the Bear Stearns moment, where we just had a really clear message that not everything is perfect. But the big one's probably not here yet. Now, Bear Stearns was, more than a year before everything really, really got scary. Is it that far off? Am I wrong to think that Bear Stearns is a good analogy? Is this maybe closer to, I think in 87, the vol spikes that preceded the really big move were only by a month or so. So are we looking at more of that scenario where something really gets ugly a month from now, a year from now, something in between, something different? How do you see it?
When this happened, and we've been anticipating a shift to a higher vol environment, thankfully, as a firm. But when this happened, my first instinct was that this is either a Bear Stearns moment. What I mean by that, it's just a tremor. And, in this case, in kind of an ill-constructed product blew up. Investors throughout the industry who engage in various forms of vol selling, of which there, are almost an innumerable number of types. Those people look at this product and they go, oh, you know what? It was a very poorly constructed product. You had to have been an idiot to have been involved in that. But the behavior that we're engaging in is much more sophisticated, and we should just keep doing it. And it's in no one's interest, by the way, to have a bear market or to call into question these strategies that they're employing, because no one wants to do it. It's been too lucrative. And if it were that scenario, then yeah, it would be more likely that we would have a big market move sometime, in a year or something. And I think that basically the most logical time to have a big move is when we're on the cusp of the next recession. That's when it makes the most sense. That's when you would look at the market and say, okay, you know what? We're really close to recession. Incidentally, very few people ever really know when that point is. But I would suggest that with this much stimulus coming in the pipe, it's not in the next couple months, right? So the most logical time would be closer to the next recession once the ECB and the BOJ are really engaging in tightening behavior. So that's kind of the most logical time. Obviously, I don't know. No one knows when a big market down move will happen. I would tell you that given the prevalence of very large vol selling and throughout the industry and the reflexivity of vol selling, meaning that as vol goes lower, people take more risk, which pushes vol down, which shows their risk models or tells their risk models that they have less risk, which means that they can take more risk. And it's just a reflexive process. That process works in reverse in a very ferocious way. And so given the prevalence and the level of vol selling, I suspect that the next material correction could happen much sooner than just a few months ahead of the next recession. I have a pretty open mind about that. One of the things that's interesting, you mentioned 1987 and vol around 1987. One of the things that was really interesting around that period was that volatility in some of the other asset classes didn't really go up very much. It was centered around equity market. I know we're talking about a very long time ago. People don't have a lot of data on that. But as we've looked at that period in time, rates vol moved up a bit and currency vol moved a little bit, but it really was an equity-centric market. And what's interesting is that this time around, it has been exactly what's happened so far. So equity vol has moved dramatically, but you have not seen any other material change. Obviously vol's gone up a little bit in the other asset class, but not by a whole lot. Anyway, I don't know when it will be, but I think the clock started ticking as soon as the Fed started unwinding its balance sheet.
I guess the question that begs is, it sounds like we are on the same page. This is analogous to Bear Stearns in the sense that it's pretty darn clear that something's wrong here, but it's not time for it to all fall apart yet. So I don't want to just pile into being short the equity market. That was the wrong thing to do in reaction to Bear Stearns. I know that because that's what I did. At the same time, I don't think it's time to put new money to work in a buy and hold strategy for, hold stocks for the long term. That's not it. I guess the question is, what do you do in this environment? Is it carry trades? And I particularly, you wrote an excellent paper back in August, The Case for Long Volatility. Congratulations, you obviously aced that call. But now that we've been through what we've been through in the last couple of weeks, is it too late for that trade? Is long vol still a strategy people should consider? And what other strategies do you look at when we're kind of in this, it's not time to panic yet, but it's not time to think that we're starting a new bull market either?
Yeah, there's kind of a short answer and a long answer to that. Maybe I'll try for a medium answer. The biggest problem in the investment industry today, the portfolio construct that investors have come to rely on, which is a brilliant construct really pioneered by Ray Dalio. He naturally has done incredibly well from this, and it's been a fantastic strategy, this risk parity strategy. And while there's certainly more complexity to it than just being long equities and leveraged bonds, let's just view it as that strategy for a moment. It's essentially what the dominant portfolio has become at all the major investors, pensions, endowments, et cetera, in the industry. And the beauty of that portfolio has been that you've been able to own risk assets, and then you've been able to own a hedge, which is a leveraged bond portfolio. And that hedge has actually paid you a positive return. The problem is when equity valuations become very high and interest rates get very low, it's difficult for that strategy to continue to perform very well, just all else being equal. Now, however, if you add modest inflation into the formula, that portfolio actually becomes pretty toxic. That's the environment I think we're entering into. And that's why ultimately I see some of these shocks like this most recent market shock as just being trail markers on this path to a much more difficult investment environment. So the question is, what can investors do? By the way, there's no big scalable solution to that. The scalable portfolio construct that worked so well was risk parity. There's no other risk parity. Kind of like when you looked at China as this big driver of growth, there's no next China. There's just one risk parity. And we've really milked that for a couple decades. So now what do people do? What they're going to be staring at are really substandard or subpar returns, some negative returns in certain years as we look out over the next 5 years. I'm not sure which year, but there are going to be some material negatives for some of these portfolios. Now, I think that there are some things to do in a more limited way. So from our perspective, we see great opportunity in the challenges that some of these big investors face. We think that really thoughtful macro firm can capitalize on those opportunities. It's ironic that so many macro firms have closed recently. I think that it's kind of classic market timing that's happened right as the opportunity set really opens up. But I think the remaining macro firms, you're starting to see them do really quite well in this environment. I think having someone focus on inflation trading, there are a whole class of securities that have been really unremarkable for lots of years that are going to become much more interesting, tips products and talented inflation managers. And then in a niche way, a long volatility product is something that is going to be able to capitalize on rising volatility levels. But again, none of these are going to be big enough to solve an industry-wide problem. The industry is just facing a very difficult period over the next 5 years. There's nothing to do about it.
I want to come back to the risk and risk parity specifically, because until a couple of weeks ago, a whole lot of people were telling themselves that stock prices and bond prices are inversely correlated and they can never both go down together at the same time. You can look that rule up right next to housing prices never go down across the board. It seems like we just got some pretty darn clear proof that stock and bond prices can go down at the same time. Does that potentially create a panic out of reinforcing vicious cycle where people start to move away from the risk parity trade because they see that the risk of both assets selling off at the same time is much greater than they previously perceived? And of course, as they do that, it becomes self-fulfilling. More and more people start to panic as the selling continues. Is that a risk that we need to be worried about?
If you'd asked me when I was a 25-year-old or a 30-year-old as opposed to a 51-year-old, I would have said yes, that's a risk of, some type of wholesale and cascading panic. I think through all these years, I've learned a lot more about how big investment committees act and how they make decisions and how they shift strategies. There have been a couple decades of analysis and decision-making that have gone into deploying huge amounts of capital in various forms of risk parity strategies. That's not going to change overnight. But I think that these portfolios are growing increasingly vulnerable and fragile. And as these big firms encounter losses through, not a month, but let's say over a few quarters, or a year, a half a year, the dynamic will be that they will start to question how robust these strategies are for, let's say, a rising inflation paradigm. Their consultants will interact with them, and then they will start reducing, and that will create more supply of risk assets to the marketplace. So it will become part of the fabric of the market. As these strategies have been deployed, they've been vol suppressors, right? So into every decline, in many respects, there has been more and more buying of risk assets, and that's suppressed volatility. And now, I think due to the decisions that we made over the coming 5 years or so, into rallies, there will just be more supply of risk assets, and that will amplify volatility. It won't buffer it.
Your office was kind enough to give us permission to share some of your excellent writings with our listeners. One of them I just mentioned is The Case for Long Vol that you wrote back in August. There's another paper that you wrote called The Interplay Between Trend Following and Volatility in an Evolving Crisis Alpha Industry. There's also some weekend notes. Our listeners can find download links for those in the Research Roundup email that accompanies this interview. But Eric, you also run a hedge fund. I know that for compliance reasons, you're not at liberty to make any particular representations about that fund on a public podcast, but we do have a large institutional and accredited investor audience. For those people who are accredited and qualified to invest in hedge funds, how can they contact you to find out more about your fund offerings?
They can go to our website, which is OneRiver, ONERIVERAM, as in assetmanagement.com. You can easily find me on LinkedIn. Yeah, those are the two easiest ways to get in touch with us. We're based in Greenwich, Connecticut.
Well, Eric, I can't thank you enough for a fantastic interview. Stay tuned, folks. Patrick Ceresna and I will be back for our postgame segment as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Now, Eric, what a great interview with Erik Peters. It was interesting. You started off kind of getting him to talk about this dislocation in the markets and where it's all going. But I just thought it was interesting. And again, we have another guest that comes on and kind of talks that stagflation story. It will be really interesting to see if that narrative continues to play out in the coming months. What did you take away from the interview?
Well, I really appreciated his perspective. You know, he's a very smart guy, and what I really respect the most is he's one of the few that's honest enough to say, look, nobody knows what's going to happen next. We can look at parallels, we can look at situations, but ultimately what we do know is where there's a lot of systemic risk that's probably going to end very badly someday. Whether it plays out in a particular time frame or a particular way is anybody's guess. And you see this so much in the industry. People, particularly on the cable networks, are trying to say they know and they can predict exactly how something's going to go down. Nobody knows it's going to go down. But the real pros, like Erik Peters and Chris Cole, will tell you, hey, I don't know if it's 2 weeks or 2 months or 2 years, but whatever happens, when it happens, it ain't going to be pretty. And I think that's really the message that we're getting from some very smart people, is they don't know when, they don't know how it goes down, but they know that the ingredients are there for a really, really serious crisis, maybe bigger than 2008. But Patrick, what I want to do right now is shift gears, because you did a webinar last weekend where you did something very interesting, I think. You took all of the corrections, 10% or bigger, that have happened in the equity market going back to 2007. So essentially, during this entire period since central bank liquidity has been the primary driver of equity prices, you took all of the 10% and bigger corrections, you charted them out, and you overlaid them on top of the current S&P chart, basically creating a roadmap of what history teaches us that we might expect to happen next. So we've got that same chart book, actually an updated version because it's got some new charts since you produced the webinar back on Sunday. And that's linked in the Research Roundup email. So if you're not registered yet, just go to macrovoices.com. You can find registration and download instructions on the homepage. Folks, I strongly recommend you to download this one because we're going to look visually at what all of the corrections going back to 2007 looked like, how they compare with what we've seen so far, and what they tell us about what to expect next, because this thing's not necessarily over yet. Patrick, your slide deck, take it away, sir.
All right. Well, the first thing that we needed to point out here is that we had to make one core assumption. The way that bear markets and selling during bear markets plays out is structurally very different than what happens during market corrections. Market corrections are kind of like mean reversions within a trend that's overextended, while bear markets are complete and total repricing of asset prices because fundamentals have changed. I had to make the assumption that this correction is just that, a correction. And so if that assumption is wrong, then this roadmap is going to be proven wrong. So if any of the listeners come to the agreement that they believe that this is probably a correction, then what we're trying to do is look at a reflection of the past market corrections as to their magnitude and duration and how they've all played out, and compare that to where we are as a potential roadmap for where we're going. So on page 2, what we have is the 2016 market correction. And what's interesting about it is that it actually took about 2 weeks to play out, and it was just over 10% in duration in the first part of the drop. By the way, just when looking at the grid lines, what I marked on the grids was marked a 10% correction level and a 20% market correction level. And then I added also 30 calendar days and 60 calendar days onto the grid. And so what we saw with the 2016 market correction was that it took up a couple weeks to play out to hit that 10% correction level. We got a bounce that lasted about 2 weeks, going to about a 50% retracement of the prior low. And then at the 6-week mark, it retested the lows again before the bottom came in. So that in the 2016 market correction, driven by obviously the scares coming from China, was really about a 6-week correction in total.
And I want to make a point here, Patrick, which is this this shape is not the only shape of a correction, but the W-shaped pattern that you're indicating here is a very common pattern that occurs in corrections. And what usually happens, especially for less experienced retail investors, it's that second test of the bottom where people went through something, they thought it was over. It's a human nature thing where, okay, we're breathing a sigh of relief. Now we go right back down to the same level, and that's where people panic and say, here we go again. It's going to be worse this time. And they panic and they sell exactly at the wrong time. So we don't know that it's going to be W-shaped. There's lots of ways this could take, but keep in mind, folks, W-shaped corrections, the bottom of the second leg down is where a lot of people get into trouble.
And so what I want to do is move on to chart number 3, which is now going to August of 2015 and looking at the market correction that happened 6 months prior to that 2016 drop. And again, the observation you'd make here is that drop to about 10% or more in loss actually spanned in just 3 days, including that last day was almost a 7% market drop. And so we hit incredibly heavy selling in a very short window of time. Even after those 3 days of heavy selling, over the following 3 weeks, the stock market retraced about half of its prior decline and yet again put in a bottom about 4, 5, 6 weeks after the initial sell-off began. And just like you pointed out on the other slide, again, kind of W bottomed along the downside, as technicians would often call that a double bottom.
And of course, no two W bottoms are the same or double bottoms are the same. In this case, the second bottom was a little bit higher. In the previous case, it was a little bit lower. The general pattern, though, you see several different corrections following about this same thing. So the real important point to realize is if we had to guess where we are right now, it's probably somewhere on the first leg up and there's another leg down still to come.
Absolutely. So the next market correction I wanted to point out was 2011. And what was really interesting about the 2011 market correction crash event was the magnitude of the drop. It has surprisingly lasted about 9 days, not much different than the length or duration of the current drop that we experienced here in 2018, except the magnitude was almost twice as strong. I mean, we wiped in 9 days a full 20% to the downside. And so if everyone thought this market correction was scary, 2011, again, from a magnitude perspective, was actually twice as deep. But again, the same pattern appears. After that first initial drop, the market proceeds to have a bounce, or some people call it a dead cat bounce, but it rallies back and retraces a good chunk of the loss. And in this case, it came back and again retested the lows about at the 7-8 week mark. And so we're starting to see a pattern here, right? The fact is we spend a couple weeks selling, a couple weeks bouncing, and then later about in the 6 to 8 week period, the market comes back and retests the lows.
And so far, the pattern that we're seeing is all of these have kind of had a W shape to them. But that's not the only pattern that we could see. Why don't we move on to the next one? I think we'll see a different pattern.
Absolutely. So I wanted to move back to the 2010 market correction, or what was the flash crash. And that was particularly very interesting on a comparison basis because all three of the prior charts, 2016, 2015, and 2011, had actually extended topping formations and a period of distribution up along the top end that happened. But what's particularly interesting about 2010 on a comparison basis to today was that in 2010, there was a sustained rally for the 2 months prior, from February of 2010 till about middle of April of 2010. We had about a 15% rally in the stock market in just 2 months. And it was pretty much a straight line higher, feeling a lot like the melt-up kind of rally that we had here go throughout January. And the other really interesting observation about 2010 was it didn't go through a big topping formation. The selling came in pretty fast and hard right off the top. And within that third day, we saw that really scary flash crash down day in the market. But what's particularly also interesting about this chart was the retracement off of the low was very, very deep. If someone was using Fibonacci's, it blew through the 61.8 going toward the 78.6 on the top side. But basically, you had a very, very deep retracement. And then it still proceeded to sell 2 more full legs legs lower, going not only to retest the lows, but then again going at about the 9-week mark, going and still making a lower low. And so in the case of 2010, the whole market correction wasn't as short as the 6-week to 8-week mark. This one actually went even 9 weeks in its total duration.
Yeah, I don't know what to say about that, but I agree. Okay, and finally, let's move on to 2007. What happened there?
Well, I thought 2007 was incredibly important to include. And I mean, you referenced it in the pregame when you were talking Bear Stearns. 2007, the reason I felt it was important to go back to here is because it was the only market correction out of all of these that we can now, in hindsight, definitively say was late business cycle. You know, we had at that time inverted yield curves. You had the credit market starting to get crazy. You had TED spreads blowing out, all sorts of different things happening. And what's interesting about it as well was that you had about a 4-month rally throughout the early part of 2007, where the S&P went from about 1380 all the way to about 1560, 1570. And then came that Bear Stearns moment you were referencing and so Bear Stearns announced that 2 of their hedge funds completely collapsed and had to be bailed out in that subprime space. And obviously that spurred a very heavy selling that led to a 10% market correction off of the top. And what's interesting is that market correction ended up being the shortest of all of the ones we demonstrated. That ended up being just a zigzag pattern down, about a 4-week correction. And then the buy on dip traders came in right away. And like you were referencing, after that low, they rallied the market into October 2007 to all-time new highs. And this ended up just being a blip in that overall bigger topping formation. And the fact that this was definitively a late business cycle, I thought it was important to reference one of these in comparison to where we are, because a lot of very smart people we have on the show are arguing we're a late business cycle.
Well, and I remember this one extremely well, Patrick, because I spent the spring of 2007. This was when I was first really making the transition from entrepreneur to professional investor. And I was spending full time doing investment research for the first time in my life. And I had learned all about subprime mortgages and the systemic risk they were creating. And I had become very, very concerned about the market over the spring of 2007. So when we got to this event and the Bear Stearns moment happened, if you look at that first purple line there, the move down, then the second purple line was the move up. On that red candle that's right at the beginning of that next purple line, I don't know the date, but I remember that day. That was when I said, okay, I see what's happening here. I have been very concerned that we have massive systemic risk that this subprime thing could lead to a lot of credit contagion. I was very astute in correctly predicting a major financial crisis was coming. And it was right on that red candle when the rally off of that first low failed. I said, the rally's failing, got something really big coming. And I remember I spent a little more than $250,000. This was in my personal account. I wasn't running a fund at the time, on out-of-the-money S&P puts. And if I remember correctly, it was the October expiry. I kind of figured, crashes tend to happen in October, so that's going to be about the right timing. And I'll buy a whole bunch of out-of-the-money puts, and I've got a windfall if this really is the beginning of a financial crisis. Well, I got the call exactly right. It really was the beginning of a financial crisis that would be all about credit contagion from subprime. But I was buying the October of 2007 puts, not October of 2008. And as you can see from the chart, what happened is just as those puts were expiring worthless, $250,000 down the drain, the market was topping because it moved on to new highs, probably just not shown slightly off to the right side of the chart here. We moved on to new highs after that, and that was the final peak in the stock market. So, this Bear Stearns moment, it was definitely the right time to say, hey, there could be a major financial crisis not too far out on the horizon. It was not time to short the stock market, and it was not time to buy puts that expired in the next couple of months. This was the warning shot. It wasn't the beginning of the big one. Now, of course, no two crises are ever the same. Maybe this is the beginning of the big one. Don't blame me if it goes that way. But I think the more likely scenario is that where we are now is, somewhere in one of these correction cycles. That's a really important warning to heed. But if you want to short something, it's probably waiting until we get through the correction cycle, past the 60-day mark, and look for where maybe there's a new all-time high in the stock market. If we get to 3,000 on the S&P, I'll be very tempted to short that. But thing to watch out for is going back to a retest of the 25-30 level that we saw on this last correction. The thing to watch out for, Patrick, let's say we get a retest of 25-30, or we even briefly get to a 24 handle. If you panic right there, it's very possible that you're selling the bottom. It doesn't mean that it can't be the beginning of a crisis, but there's a really good case for that being the second bottom in a double bottom pattern or a W-shaped chart pattern. So just beware of that one, folks. It certainly tripped me up in 2007.
Thanks for sharing that story there, Eric. It's always interesting reflecting on, we learn so much from our own mistakes, and it helps so much to make a plan. Anyway, so I want to keep moving on, though, because we have a few more charts that I wanted to cover. And on the 7th chart on the page, what I did was, now that we kind of drew out all those patterns of all the past market corrections, I overlaid them all over the existing market decline. Now, first observation I make is that this was the chart I shared with the MacroVoice listeners that joined me for the live webinar back on the weekend. So this is as of February 9th. And so we were literally in the midst of the market drop. That Friday reversal was there. But really, there was a lot of uncertainty. And when we mapped all of these on there, what I did with the red boxes and subsequently the circled areas is to identify where the clustering was of subsequent bounces and where subsequently the next wave of the correction happened in the past. I thought it was a really interesting way to look at it.
So I think it's important for people to understand, if you're looking at the market now saying, hey, look, it looks like it's recovering. Maybe it's time to buy here. Well, if you look at the preponderance of evidence, if anything, it's very possible that we're just about to reach a peak on this bounce where maybe we're about to start to move back down for a retest. So buying here, expecting the market to go straight up from here, is not really consistent with what past history has taught us. Let's move on to the next slide.
Slide number 8, what I did here was actually just update the chart to reflect what just happened this week. And we can see that the rally has come right into that target zone where so many of the last few bounces and market corrections have come in the past. What's interesting about this level, I reflect back on the interview there we had with Eric Peters, and he kind of makes that point saying the market goes through the process of discovering the pain points of trades and guns for them. And I would think that there's a lot of people that started to get short during that drop, thinking it's the big one. So, while we're already sort of at this 27.30 level here as we're recording, I would not be shocked if there was still one more good solid push higher to just clean up all of the weak hands that got short too early and didn't have it properly hedged out. But if this as a roadmap, and I want to keep emphasizing that when you're looking at this chart, I want to make it clear that this is not our forecast, but rather just a roadmap of past market corrections and kind of just overlaying to what would happen if this played out very similarly to past ones. And so there's a lot of precedent to the fact that this market will still have a significant retest coming into the month of March. And that's probably where we'll see some more important turning points in the market. That zigzagging is very important to kind of take a lot of the weak hands through rinse cycles up and down and then make their bigger moves afterwards.
Exactly, and I think that using this chart and continuing to update it with what the market's doing and comparing to past cycles is an excellent way to navigate through this. Patrick, on the next slide, you've got a link here because everything we've just talked about was actually an excerpt from what you covered in this webinar that you did this past weekend. People who want to see the entire presentation, which goes into much more depth than we covered here, talks about option strategies for trading this and so forth. That's available for free at Big Picture bigpicturetrading.com. I'm going to step in here, Patrick, and just mention to our listeners, when Patrick joined me in this MacroVoices project over a year ago, he emphasized that he didn't want to turn it into an advertisement for big picture trading. He would just give away some free content and hope that the business would follow. And it's very generous of Patrick to sponsor the show and give us his time and energy. I'm going to overrule Patrick on his soft sell policy and just say, folks, if you like this content, what we've just covered in Postgame, this is just a sample of what Patrick does for a living. He's in the business of selling. Yes, you have to pay for it. Excellent content just like this. You can learn all about it at bigpicturetrading.com. Patrick, that's our one advertisement that I have to get in, even though you've preferred not to use the show as an advertisement for your business, which I know all of our listeners really appreciate your style in doing it that way. But I just had to get a plug in.
Thanks, Eric. Well, all I have to say is that for our listeners, we have so much great new content still coming. We're inviting many of these guests back to kind of give us updates on this, and we're going to keep updating these charts and commentaries on the market to give all of our listeners the play-by-play of how this plays out and where all the big opportunities are.
I'm really looking forward to it. We've got super content coming in coming weeks and months. Meanwhile, we're out of time for today, so you've heard it before. Folks, we need your help promoting the show. Please forward your Research Roundup emails. Tell your friends and colleagues. Most importantly, if you haven't yet, go to macrovoices.com, register your free account, because the more registered users we have, that's the statistic that Patrick uses to negotiate to get the very best feature interview guests on the program. So please do your part to help us get better guests by signing up for your free account. The benefit to you is you'll receive our Research Roundup email, which never contains any advertising or marketing. We're not going to spam you or try to sell you anything. It's just a compendium of links to all of the coolest content that we could find on the internet, both from our own guests as well as elsewhere on the net. Patrick, tell them what's in this week's Research Roundup.
All right. Well, first off, you're going to find the transcript link for the interview with Eric Peters, as well as all the links to all the great articles Eric has chosen to share with all of our listeners. You'll also find the chart book that Eric and myself discussed in mapping the past market corrections. There's also a fun little blog article written by Kevin Muir from the Macro Tourist titled Fading Ray, where he discusses the idea of Ray Dalio and how he's building this massive short on Europe. And at the time when Kevin wrote it, Ray Dalio was about $14 billion short those European markets. And since you wrote that blog, Ray Dalio has doubled down, now bringing that up to $22 billion. So I'd love to get a further update from you, Kevin, as to whether you're still wanting to fade that. So you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.